Happy New Year. Welcome back. I'm David Darst. Hope you had a good start to 2022. What we want to do today is review the fourth quarter and give you a little bit of a 2021 wrap-up as we enter this new year. It's hard to believe, but last year, the economy grew approximately 5%. We'll get the final numbers. The Fed thinks it grew about 5% after contracting 3.5% in 2020, as you know. Corporate profits, so far, the numbers look like they're going to come in approximately up 49%. The inflation rate, you're going to love this, the inflation rate rose almost 4 times. A year ago, January of 2021, the inflation rate was 1.1%. We closed out November, that's the latest data that we have, up 6.8%. That's for the consumer price index. The producer price index was up even more. And the Fed's preferred measure, that's personal consumption expenditures index, after taking out food and energy, up 5%. Now, with all of this going on, profits up, the economy up, inflation up, you would have thought the 10-year Treasury yields would have really skyrocketed. No, they went up only about 59 basis points. They closed 2020 at 93 basis points, and they closed 2021 at 1.52% for the 10-year Treasury. So you had this recovery. You had inflation up, growth strong. The Fed and others think that growth will begin to moderate. This recovery from the depths of March of 2020, the pandemic drawdown, slowdown, the recovery has been a lot longer and stronger than anyone had anticipated. Inflation is picking up, has picked up, and growth is moderating. Therefore, investors want to think about and begin to transition in their minds and reposition their portfolio and their asset allocations from an accelerating growth environment to a moderating growth environment. We basically are seeing in the public markets, not only in bonds, but in stocks, you're seeing very high public market valuations. Price earnings, price to book, price to sales, market capitalization to GDP, market capitalization to replacement cost. Many of these valuation metrics are in the 95th to 99th percentile versus their historical record. The private markets to us seem, by contrast, to offer some degree of attraction. They do not seem as stretched and as overly highly valued. This market, the public markets, are priced for perfection. And we don't think this is going to be a year full of nothing but perfection. Private market assets, you're talking about private equity, private credit, and private real estate. They tend to have lesser drawdowns than public markets when you do get stumbles and when you get resets and when you get drawdowns. We also would be emphasizing at this point growth capital within the private market space rather than income generating capital. At the same time, we do recommend diversified approach, okay? Now, to wrap up, as we position ourselves for 2022, what are the themes that we want to emphasize? What brings all these things together? Number one is growing but slowing. So the economy is expected by the Federal Reserve, again, after that 5% growth, to grow something in the neighborhood of 4%. Corporate profits, which grew 49 or 50% in 2021, are supposed to grow 10%, according to FactSet, in 2022. Look, I think that might be exceeded. Who knows? Let's see. The consumer's in good, strong position. Corporations are in good, strong position. Monetary policy is beginning to tighten. Fiscal policy is nowhere near as stimulative as it was. But now we have the private sector, companies and individuals who want to spend and who have the capital. They have the wherewithal to spend. So that leads us to theme number 2, which is transitioning. We are in a transitioning policy environment. Make no mistake, this is not the same accommodative policy environment that we had before on the monetary side, much less on the fiscal side. I do believe that one thing that's overlooked this year, they were talking about all kinds of tax increases throughout a good part, as you know, of 2021. It looks like some of those big tax increases are not going to take place. This leads us to number 3, is fluctuating volatility. Fluctuating volatility in stocks, in bonds, and in currencies. So we expect volatility to pick up. That's one reason why we do like the private equity, private credit, and private real estate asset class. The next one is differentiating, and this is where selectivity becomes paramount in importance. You can get private equity or private credit or private real estate. The difference between an A student and a C student, or the 75th best and the 25th best, is enormous when you get into private markets. In public markets, it's much harder to get an edge. So the difference between a 75th and a 25th best is narrower than it is in private markets. So selectivity in assets, in manager selection becomes extremely important in the environment that we expect for 2022. And lastly, is challenging. So we have growing but slowing, transitioning, fluctuating, differentiating, and lastly would be a challenging environment. We think the easy money has been made, so it's going to be much more. It's going to be much more challenging to navigate the ups and downs that we foresee that we will have. We're constructive, but we do believe with these high valuations, you're going to have some drawdowns, and you're going to have some periods where it looks like that it's time to abandon. But we don't think so. We think it's a time to be much more flexible and much more agnostic. Don't be dogmatic. With that, we wish everyone a very, very happy 2022, and may it be filled with promise and with affirmation for you and your loved ones.